And let's see, let's take a look at trying to remember off the top of my head what type of questions I've been having come over the emails. So I'm just kind of looking over here. Let's take a look at the multi-leg trades again. So one of the things here is, just we'll review really quickly what the multi-leg trade analyzer is. And this is looking at actual trades that occurred yesterday, and the software analyzes the options trades and sections off the ones that included multi-legs, and single legs. So the multi-leg trades are trades that involve more than one leg, right? It could have two options that have to be executed simultaneously, like a put spread. It could be three options. It could be ratios. It could be an option in the stock. So the software organizes that, runs an analysis, and makes its interpretation of what happened here. And then over here we see, a line item for particular strategy that it detected. So over here we have 81 different strategies yesterday that it detected in SPY, right? So strategy could be a put spread, could be a call spread. So 81 different types of strategies. And this is a filter. We're on today's, you could go back days, but this is the filter, and we could open it up. And this filter itself is a report which lets us select a particular strategy. So here we see put spreads. Those involve 515,980 contracts, and there are 2,767 unique put spreads. So what a unique put spread could be, there are different combinations, right? You could have different strikes. You could have a put spread on different expiration. So all these different combinations, there's over 2,700 combinations of put spreads yesterday that traded. You could see below that call spreads, diagonal. So this gives you an idea how people out there are using options in SPY, right? What were the most popular strategies? How many options traded in that particular were involved in that strategy? How many different types of unique combinations? So this gives you a really quick summary of what's going on in the multi-leg trades. And we could go down here and we'll see there's lots of different, over 81 that we detected. You can see covered calls, calendar put spreads with extra put, collar. You could see lots of different ones, right? And then some don't trade that many contracts, but the most popular ones up here are the vertical spreads yesterday. And so what we could do is select one. This shows us the top 5 by volume. So we could see here in the top 5, 1, 2, 3, 4 were regular vertical put spread. 1 was a diagonal double put spread, which looks, just knowing SPY and like watching these, it looks like maybe it was a roll of a put spread from April 18th to April 23rd. We could open that up and see if the open interest, kind of confirms that. But here are the 4 legs, right? So April 18th, 500, 505 put, and April 23rd, 495, 500 put. So here is the total volume in each leg yesterday. Here's how the open interest changed. So, there's other options trading around there, right? That's not the only, those are probably not the only options that traded, but just looking at how this open interest looks like it declined in April 18th, increased. See how significant it increased in April 23rd. It does suggest that this was a roll of a put spread from one expiration to the next. Okay, so this is just giving you a quick way to try to figure out what went on, right? So that's what we're doing right now, just seeing that, okay, this is a diagonal put spread, which was a roll that somebody took it from one, held a perhaps a put spread in one expiration and decided that he wants to get out of that one and roll into a different put spread on different strikes in a further out month, further out expiration. So I'm going to close this for a second. And let's say, what else we could do is say, well, maybe we're interested in a put spread, right? Maybe that's something that we're looking at, and we might want to see, well, what other people are doing and where are they trading, right? So we could just filter out put spreads here. And now we see there's a bunch of put spreads, right? We've got a bunch of them over here. There's a lot. These are the top 5. And we could see, where the expirations and the prices they're trading at. And this kind of gives us an idea that if one of these put spreads, right, kind of fits the expiration we're targeting, maybe even the strikes we're targeting, we have an idea where it's now trading, right? Where we have a better idea of price discovery of where are people matching up. So let's just say that I am looking to perhaps do a credit put spread, right? How would I use this? Well, if I'm looking to do credit put spread, one of the things that is important, let's say I did the analysis, I'm good, is that, I want to get a good execution, right? So I want to, so if you're selling a spread, right, selling a put spread, well, what's important? It's important that you could sell it at the highest possible price, right? If you're selling something, you want to sell it at the highest possible price. If you're buying something, you want to buy it at the lowest possible price, right? That makes sense, right? When you're buying something, the lower the price you're buying it at, the less risk you have, right? And the more potential reward. And when you're selling something, well, the higher the price you get, right? You're taking in more, so that's less risk and the higher potential reward. So when we're doing that, we would be seeking, well, where are the put spreads trading? That perhaps maybe somebody could be buying them out there. Maybe there's a demand to buy, but if I want to be on the sell side, I might get a better price, right? Because there's a buyer out there that's willing to pay a higher price. And if I want to, and if I want to sell, if I want to buy it, well, perhaps somebody out there is selling it and selling it at a good price, and I might want to be on that side and get a better price for buying it, right? So just looking at this, I'm just gonna look, I'm just scanning it with my eyes. I see here are the trade prices. So over here, let's just look at these five. Over here, I have five different spreads, right? That traded significantly. This one, total 55,000 contracts. It traded 278 different times. So it's trading a lot, right? Perhaps that with that much trades, I could get in on a trade here. This one traded 30,000 times, three different times. This one traded 20,000 contracts 39 different times. So if I open it up here, let's just take this one. You could see that it's been trading a lot, right? Here you go. So looking at these, and I'm just eyeballing this right now. I'm saying if I'm looking for a credit spread, right, and I'm looking to sell it, well, right there, I'm hovering over one, where this one looks like, hey, it's trading closer to the ask price. Meaning I might, how they tell you try to get the midpoint. Well, why not try to get better than the midpoint, right? If you could get the midpoint, or you could get above the midpoint when you're selling, well, that's even better, right? That's even you're selling it at a higher price. That means you're bringing in more money, right? So this one's here at 305, right? So there you have, perhaps a chance to sell it, near the offer, where you could put in, an offer and see, you could perhaps get a better price. Here's one right below it. Maybe I'm trying to buy a put spread, right? And right below that one, I see here's one that traded below the bid, actually, right? Like that's how the VWAP bid was 371. The VWAP asked 375 and traded at 370. So here, let's look at that one. I'm going to open it up. And you could see here, my EdgeX traded it. This one looks like it traded really quickly, not throughout the day, from 9:33:35 to 9:33:37. So perhaps that person's already done. You could always try to see if there's more. But this one here looks like there was a big seller willing to, really was aggressive, and looks like that even traded below the displayed bid, right? So these are like the things that also could help you out when you're looking for quality of execution, right? So let's just take a look here. Just to get, let's see if we could find more that are, on the bid or offer.
Hey, D.
Yeah.
We did have a question from, I think it was from Jackie. He was like, how do you know those put spreads on SPY were either sold or bought? I mean, they had to be both, right? I guess.
Well, there's a trade that happened, right? So
yes.
there was a trade that happened where there was sold or bought. Right there, somebody bought it, somebody sold it. You need both sides. So what are we looking at is that we know the price that the trade occurred, right? Because we could figure that out, right? We see the trade and we see the prices. We could figure that out. That, so what are we going to do here is we could see that, here's the spread, right? So here's the spread, that one side traded for 47, the other 143. So put spread, right? One minus the other, 96 cents. Well, we also can take a snapshot picture of what were the bids and offers at that moment in each leg. In other words, there's a displayed bid and a displayed offer. right? Which a displayed bid is at that moment, that is the highest somebody is displaying they're interested in buying, right? That's the highest bid, the NBBO. And the ask is it's displaying the lowest price somebody's willing to sell it, right? So we have the bid and ask interest, and then we have the trade where it occurred. So then we could kind of start, trying to infer what's, where the trade was relative to where the market is, right? So let's say you're trying to buy, a house. Well, somebody's, like there's a condominium with a bunch of condos for sale, and the lowest one is, offered at 150,000, and somebody's bidding, somebody's interested to buy, but at 120,000. Well, now you have an idea where there's buyers and sellers, right? Where they're trying to buy it, where they're trying to sell it. And then all of a sudden you have a trade there. Somebody transacted. It could be somewhere in between. It could be somebody who bought it the asking price, somebody who lowered their asking price to where the bidder was, or something in between. So that's what we're trying to do, is figure out, well, where was the actual trade relative to the market's displayed bid and offer. Okay. And here, that's what we're doing. We're comparing those prices. So the trade happened at 96 cents. Well, if we looked at the display bid and offers at the time, which means, those displayed bids and offers, keep in mind, once they're displayed, they're firm. That means, you could enter in an order and buy it at that price or sell it at that price, right? So the displayed prices are they're already firm. It's not something, where it's a suggested. Once you put it out there, somebody could hit it or somebody could take it. So here we're comparing where did the transaction take place, what price, versus where was the market at that time displayed. So we see here that this one traded at 96 cents. That bid was 92 cents at the time. The ask price was 96. So what's the inference? That somebody stepped up and was willing to pay the displayed offer, right? They're willing to say, fine, that's good enough for me. I'll pay 96 cents. So that's what so again, there's a buyer and seller, but somebody stepped up to take the displayed offer. And this also lets us kind of know where so why are we looking at this as well? Not that, just because somebody did that doesn't mean they're going to be right. We don't know which side's going to be right or wrong. That's not what that's not what this is going to tell us. But what this tells us is that it looks like in this spread, the incoming orders, right? The incoming orders that are the end user, the one that's the initiator of that order, looks like they're coming in from the buy side, right? They're coming in and they're willing to pay the displayed offer. So if you're looking to sell it, right, now you have that information. You say, well, wait a minute, before I go in there and try to sell it at 92 cents, I may be able to get better than 92 cents. There's a good chance I get 93 cents, 94 cents if I sell it. 95 cents, maybe even 96 cents. All right. So when you look at that, you're like, well, is that a big deal? Well, okay, you have These are the things that add up over time, right? You have 4 cents there, right? 4 potential cents on this spread that you could get extra. Well, take 4 cents, 92. What's that? Over 4%, right? That's over 4% extra to make on the spread potentially, right? You sell at 92 cents or 96 cents, you're talking about 4. So annualize 4%. Think about the trades that you're making. Keep adding 4%, 4%, 4%. That's the difference between success and failure. That's the difference, right? Because how are you going to make up that? If you're trading inefficiently, imagine what how good are your miles that you could just give away 4% every time, like try to do that with any asset. So that's the idea there is that you could use it in many different ways to help you trade more efficiently, and first of all, you see what people are doing as well. Even that makes me, because you want to know how people are using options. What are they doing? Where are they doing it? How often? So these are reports are very important from a lot of different perspectives, and we just looked at a couple today. Hopefully, we're right up at 9:30. Well, I'm gonna.
That was great, D. Thank you so much. Tomorrow we'll look at the Netflix earnings. It goes has their earnings after the market closed tomorrow, so we'll look at it before the market opens. Awesome job, buddy.
Great. All right. Thanks, everyone. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trade in peace, chameleons. Everyone have a great